Owen, I'm well, and you?
Pretty good. Excited to be chatting with everyone today about investing for kids. Caroline, already in the chat. Hello. Justin. Justin, it's good to have you here, given that we talked about this stuff many months ago. Mitch, what have you been working on?
What have I been working on? It's just been getting this Luna portfolio finally up and running because we've been, seems like we've been talking about it for a little while. So it's good to have it up and running, and I can confirm that we have at least one investor, being myself, in there already. So we're definitely eating our own cooking here. But I also had a little backlog of enthusiastic Rask community members that are starting to pile in now as well.
Yeah, that's great. Hey, Kylie. Jonty. So today we're going to talk, as per usual, like our monthly update, because it's not just kids that are now likely able to invest with it, it's also all the adults that are in the room. So we'll talk a little bit about that. We'll talk about the Luna strategy, why it launched, how it's a little bit different to quite a few other things. And also just answer your questions, because we know that there are a lot of questions around this. So we've got a few things that we'll be able to send you away with today as well. Later today, you will find our owner's manual, which is something that we've promised for a little while. So this is a document which you might be able to read over Christmas. I'll give you a sneak peek at it now. It's done. I'll just show you now. Bring it up. There we go. That's probably a bit nicer if I do this. Some magic in Canva. Here we go. So this owner's manual is coming out today, and it takes you through all of our investment philosophy, how we invest, why the company exists, and just everything you would want to know before investing with us. But crucially, Mitch, it also says what we expect from the people that invest with us.
Yeah. There's it's investing even in a service like ours, like Rask Invest. It's a two-way street. Like, both parties have to be on the same page, and that's because we could do everything that we say we're going to do, but if you sitting there holding it, chop and change all the time, if you don't stick to a specific time frame or invest, say, in the wrong risk profile, etc., you're not going to get the desired outcome. So it's certainly a partnership.
Yeah, absolutely. Which is probably, maybe you'd want us to say that, or maybe you think we should. But to be honest, in most of this industry, people would just take anyone who can fog up a mirror, to be honest. And we do not want that. We do not want just anyone to join and invest with us, because we want you to get a good outcome. Yeah. And I think that's been evident in everything that we're doing. So this will be out today, and I think we're pretty happy that everyone that's invested with us so far are the types of people that we want invested with us. So that's great.
Yeah, no, exactly. I think I was just looking at the stats today. We're just about to hit 200 investors with Rask Invest, 13.2 million in funds under management. And I can tell you from my own direct experience, the investors that we have on board now, those 200 people, are incredibly long-term focused. They understand what we do. They understand why we do it. They make my life easy.
That's good. We will share this weekend, and also just in the general literature, how we would invest. This email went out a few weeks ago, investing for kids, but we're going to have an extra option here of how you can do it with us, just so you can see, basically what it would take to invest for kids, how we think about it, the tax, the returns, the this, the that, all that sort of stuff. We can be a bit more direct with that now, thanks to the approval of this new strategy. So we put together some slides, usually on the Rask Invest live show every Thursday. We run through a few different things. We answer some questions. We have a bit of fun. But today is very particular, because we're going to talk about investment performance. We're going to talk about investment products. That's what we call them. It's really important to understand this point right here around the warning that we're about to give you, which is...
I was hoping we'd get to this.
Yeah. This is the best bit of every week, mate. So general financial advice is all we can deliver on a live show such as this. If you want personalized financial advice that takes into account your needs, goals, or objectives, you should speak to a licensed and trusted financial planner, someone that you can verify on the moneysmart.gov.au website. Rask Invest is what we call a financial product. So it has a product disclosure statement and a TMD, or target market determination. This TMD one's a really good one. The reason being, if we're saying it's only general information, you can use the TMD to basically make it more personalized to which option you should select when you invest, or if the investment is right for you. That's what that document is designed to do, to overcome that kind of part of the law where you're just like, I just want to invest. Which one should I go with? You can kind of make that assessment by using that document. You can read our financial services guide, which is available on the Rask website. All of the documents are available in the footer of the website, so you can go and check that out. So obviously, if you haven't already subscribed to YouTube, you can do that now. It's great. You get all the podcasts and everything every week. So Mitch, let's talk a little bit about Lunar Kids. We'll dive more into it in just a sec. High level though, what is it?
Yeah, really high level. It's our fourth Rask Invest portfolio. Technically, anyone can invest in it, but it's designed for the use of those investing for children. It's got a recommended time frame of 10 plus years. That's because technically it is an all growth portfolio. So there are no bonds or cash assets sitting in the portfolio. Come to it, it's the management fee is the same as all of our other portfolios, 0.55% per annum. The main difference, though, is we have lowered the entry level for this particular portfolio, understanding that parents are generally starting, say, smaller. So our Jupiter, Terra, and Martian strategies all come with a minimum investment of $20,000. Of course, it's a bit steep for me to be starting my son's account at. And so we wanted this to be accessible to a lot of people. Just a quick note on that. In the short term, we have limited accounts opening for less than $10,000. So between $5,000 and $10,000, we've limited those to 10 per month. The reason for that is, and I'll actually get a bit deeper into this later on, just complete transparency, we lose money on accounts that are less than $10,000. And so just in case, as an act of an abundance of caution, in case we did this webinar and 1,000 Lunar accounts opened that were sub $10,000, whilst we're still scaling the investment business, we wanted to just put a little, just something in there to allow us to ensure that we're sustainable through this period. But in time, as our funds management business grows, the other accounts will well and truly offset the sub $10,000 Lunar accounts, allowing us to service everyone, and we'll be able to take that limit away.
Yeah, just so for anyone's benefit, if you've already invested with us, it makes a lot of sense for us. We're not here to say, we entered Rask Invest, which we'll talk about in just a moment, but we started this journey expecting it to be, multiple years, multiple decades. So even though we may lose money on some accounts and we can sustain that. That's absolutely no problem whatsoever. Mitch just alluded to a point that it's really just for a particular niche group of investors. If you've got more than 10 grand, it doesn't really matter. It won't count towards that. And even if you're an existing investor, just come to us. Like that's basically what we want. We basically haven't promoted this too heavily for that reason. But they're effectively exactly the same infrastructure. There's no change with them. So there's still, everything else is still fine. The key difference is the strategy. Many of you, like for example, I know Justin, have been with us since even before we launched Rask Invest, and have been like actively engaging with us on different things that we can do. And this is only the first instance of that. So what I mean to say is, like, a lot of people have also asked for an all growth strategy. And that's something which we are actively moving on in the background, as well as the core and the satellite approach in how you can mix and match certain things. So these are all things that are in our product roadmap. And those are things which this was the first one off the rank. So I just want to...
Yeah, so on that, the like an all growth strategy suitable for an adult, and we'll get into why that is on the product roadmap for next year. And maybe let the cat out of the bag a bit here, Owen, but we've also discussed an enhanced income strategy as well. They're the two things that really, if we're going to bolt on anything to the existing portfolios, something that makes the most sense. So if you are looking for an all growth strategy as an adult, then I would wait till next year.
Yeah. So we'll come to all of it in just a sec. Sensei, you've asked a really good question there. We'll come back to that. Other than the fact that you mentioned that we should do a collab with Loon Croissants, which I would be up for. If you head down there, let them know that we're coming. Let us skip the queue because it's about 40 minutes.
Yeah, I'm not waiting 40 minutes for a croissant.
It's worth it, to be honest. Okay, so Rask Invest so far. So obviously we've got the three main strategies that have been running for over 6 months now. You can see the return performance here. Past performance is not indicative of future performance, as they say. That's a really interesting, we've spoken about this in the past, but to say that legally we have to. Past performance is not indicative of future performance. Key insight being that a lot of that stuff around performance in the past was because a lot of people with stock portfolios would have one great year and then crash the next. When you invest in a diversified portfolio, you tend to get a smoother journey through time. This is not normal, to be clear. Like in 6 months, do not invest with us expecting that we're going to do 11% in Jupiter every 6 months until forever. That's, we could come out and allude to something like that, but we're not going to, because that's not what you should expect from us. That's probably, maybe some years we do this, but that would be on the higher end of what I would expect from a 90-10 portfolio. You can refer to our website for the guides on where we think performance will fall over time. We're pretty conservative, but you'll see a guide for that. There's an illustration of this in our owner's manual, which I'll come down and I'll pop, where is it? Here. If you think about long-term investing, right? You think about, well, what are the best stocks? That might be this yellow line. And then what are the kind of the safer assets like government bonds or cash? That might just bubble along the bottom here, right? If you've got a diversified portfolio, you're never going to do better than the best and you're never going to do worse than the worst. You're going to be somewhere in between. So this is basically where we pitch our strategies, is somewhere in this mix. So keep that in mind. What we've experienced is probably one of these faster growth phases. I'm not alluding to anything bad happening, but we've had some pretty good growth. Interest rates, the big reason for that is interest rates have started falling across the world. They haven't fallen here in Australia. In fact, we've probably been we've been the outlier with rates globally. This year, we've also seen Aussie shares, US shares, I should say Aussie and US shares, just rocket, because we've seen, in particular, the US share market, we've seen the mega cap stocks lay off hundreds of thousands of people over the past 3 years. At the same time, their profits are going way up. We've had a new president elected in the US. We've seen the Fed start to drop rates, and we've seen a lot of the geopolitical uncertainty, the war in Ukraine, Israel and Gaza, that has been happening now for a while, and the market has kind of absorbed that. And so they probably, just generally speaking, probably expect that they can move into what we call risk on assets. So money can flow from maybe gold or maybe from other things into shares again. And so we've seen a big uplift in, those types of companies and in those shares in particular. Bonds, our bond positions have performed in line with my expectations. We've been in the same or similar position for probably 2 years now, in that we've had a position in the VBND ETF and the IAF ETF, which are kind of staples for a diversified portfolio. VBND has performed very well. IAF, which is the Australian bonds position that we hold, has been, I think last time I checked, don't quote me on this, around about 5% year over year, and about 3.5% of that 5% return has come from income. So don't forget, when you look at a share price chart of one of the bond ETFs, that a lot of the return is going to come from income. So the share price chart won't show that. Our returns are total returns, so they will show that. But you can see here, like very robust across the board. We're very happy with this. We don't necessarily expect 6-month figures to look like this. There will be bad times, but over the long term, we want that steady march of compounding, and we want to be able to do more for you. Not just these 3 strategies. We want you to be able to bolt things on and maybe wiggle some things around. Now, we might just talk generally about investing for kids, unless there were some questions on that.
There's just a question there from John T. Did I hear right that it's 20K minimum to invest with Rask? The recommended minimum for Jupiter, Martian, and Terra, those 3 strategies, is $20,000. Technically, we can take down to $10,000. Just contact me if that's the case for yourself. But the recommended is 20,000.
Yeah, so recommended 20,000, but technically we can take down, Jonty. So keep that in mind too. Now, we've done a lot of content lately on investing for kids, and it's not just because we're conflicted finance people who had a investing for kids option that we were working on. It's actually because everyone was asking about it too. So it's kind of like 2 birds, 1 stone. But we have done a lot of content lately on investing for kids, and there are many different things that you can explore if you're a parent or a grandparent. There was a good question here, Mitch. Maybe this is a good way to set the scene from Sensei. Can parents, of a young child open a Luna account in the child's name, or will it be in the parent's name?
Yep, Sensei. So essentially what happens is kids legally cannot own, anyone under the age of 18 cannot own stocks in their own direct name. So what happens is, if you go to a broker, if you go to a fund manager like ourselves and you're opening up an account, the account would be adult as trustee for child. So how that'll actually look on your statements will be, Mr. or Mrs. Sensei, then brackets, child's name, close brackets. Then you'll have the option to put down someone's tax file number, which we'll get into. And that's very important to speak with an accountant before you go through with that. But essentially then whoever's tax file number is down is the person is one that's paying the tax on the investment. We'll get into that in a little bit. That's quite critical to think about when looking at kids' investments. And then I should say, when the child turns 18 or any time thereafter, you don't have to give the kid the kid keys to the account when they're 18. I know it's probably would have been a bad idea when I was 18 to do that. So you might hold off till they're 20, 25, depending on your own circumstances. And then in our case, what would happen is the child opens up an account directly in their individual name. The child and the adult both sign a letter saying, please transfer these assets across into this new account, and we do that. Now, depending on whose tax file number was down, this may or may not trigger a CGT, a capital gains tax event. So but that's where we're going a bit far down the rabbit hole right now. Yeah,
so Sensei, it's a great question. It's the first question any parent asks is, can I invest for my kids? And yeah, it's a little bit different to some other things. You effectively, as a parent, you have to hold the shares legally, and then underneath the surface, there's what we call a beneficial owner, and that is typically the child. What, in my interpretation of just looking at much of the information, is that in many instances, most parents don't need to worry too much about tax. And I'll give you, that's probably something that flies in the face of a lot of things you might have read, because you may have seen in the past that kids pay a very high amount of tax on a certain amount of income, say beyond $416 or whatever it is exactly. So if they earn, say, $500 a year, the 400 and whatever would be tax-free, but then the little bit above that is taxed at pretty heavy.
It's at about 60%, and then it drops down after the earnings, after the income reaches, I think, what, about $1,400-ish, and then drops down to 40%.
Yes.
Still a significant tax rate.
Yeah. So it's one of these things where parents often get, where is it? It's just here. Oh, I've just lost it. There it is.
Somewhere.
So parents often get spooked by this because they often see, or grandparents, I should say, often see that a child's paying like 60% tax. That's a lot of tax. So I'll do everything that I possibly can to avoid that. Key point being, a lot of parents pay high amounts of tax as well. And as long as you structure the investments correctly, you may not get a lot of income on a child's portfolio. And I think people put a lot of time into thinking about the tax position that they often just neglect. Well, if we're going to be paying tax, okay, but I want a good return. And that's probably the key thing to keep in mind. Now, the child can keep earning money, just like, part-time jobs and all that sort of stuff. And that's just like normal. We're talking about income that they don't necessarily earn. And that's just to stop parents from putting all the money that they earn in their kid's name. And here we go. So what does this say? Peter withdraws $3,000 from his own bank account to buy shares in the name of his daughter, Georgia. Peter quotes his TFM when he buys the shares. He deposits the dividend of $200 into his own bank account and uses it for his own personal expenses. Peter declares the $200 on his tax return. When he sells the shares, he will also declare any capital gains tax or loss. Now, there are various instances, and I can share this with you now, where you can do things that will be in your favor longer term when you transfer assets to kids. But I'm getting a bit ahead of myself too, Mitch. So let's talk about this. I've alluded to it. Asset selection is critical. What do you mean by that?
Yeah, so onto this one. For me, asset selection is really critical when it comes to investing for kids, because you want this investment to compound for decades. Okay. My intention of when I hand over my son's investment, he's 2.5. When I hand over the investment to him at, say, 18 or 20 or whenever, that's just the start. Again, that's for my intention anyway. I mean, who knows what he's like at that point in time. It's my job between now and then to ensure that he doesn't bugger it up. But he sees it as a foundational investment for, continuing to grow his wealth no matter what he decides to do. And so for mine, asset selection there is very critical, because I want to be selecting investments that are going to be here for 20, 40, 50 years. And so for me, if I'm looking at, high growth thematic ETFs or something like that, the thematic could play itself out within 5 years, 6 years, maybe 12 years, maybe 15 years if it's a long-term thematic. And so that's why I've put here longevity really counts. And so the two ETFs that we've chosen for the portfolio are bog standard index tracking ETFs that I believe are perfect for compounding for decades. So the ASX 300 through VAS, the S&P 500 through IVV. And if you think about these two ETFs, or just these two indices, they are within themselves fantastic long-term thematic ETFs, as in they naturally evolve with the themes of the time. So, if you look at the S&P 500, it's not always been dominated by tech. If you go back a few decades, you'll be looking at, general, like GE, you'll be looking at Ford, railroads, things like that. And it's just an ever-evolving ETF. So you're constantly having exposure to whatever that latest trend is in a very tax-efficient manner. So that's why, this is cool. There you go. That's why I say asset selection here, and how you get it is quite critical, because you don't want to be chopping and changing. You do not want to be locking in an unnecessary tax event for yourself. So you're wanting to let the power of time, because you've really got time on your side here, you're wanting to let the power of time do its job.
Yeah, and that's a lot of people, this is a really important point that people miss with index fund investing. You can see it just here perfectly, like I said, Mitch, like, look at this company right here. For those of you that don't know this company, Philip Morris is a gigantic cigarette company. And you can see in 1990, sitting right here, disappeared by 2000. I wonder why. 2010, not there. 2024, it's gone. But you also just compare this list to the internet era of companies, and you can see that here. You can see them slowly bleeding through. And who knows what comes next? Maybe it's a range of EVs and rocket ship companies. Who knows what comes next? But the beauty of an index fund that gets this is that it captures it all along the way and automatically rebalances and can do that for you through time.
That rebalance, probably jumping ahead here, but that rebalancing is incredibly important in the nature that these index tracking, market cap weighted index tracking ETFs do it. If you ever hear a fund manager talk, they'll often say they want to let their winners run and cut their losers. An index fund, an index ETF does that naturally by the winners becoming larger and larger and larger chunks of the portfolio due to that market cap weighting. And then the companies that perform poorly, it's not that they are being sold down within the ETF, it's just that their market cap is becoming less and less and less. And so it's got less of an impact. So your losers are having less of an impact on the portfolio. Your winners are having a bigger impact on the portfolio and naturally weighting towards that. And that's why indices are actually incredibly difficult to exceed as an individual investor when stock picking.
Yeah, and that's one of the reasons why index funds work well for kids' accounts, is because if you invest in an active strategy and they're constantly buying and selling, we call that the turnover rate. Even though you're not doing the buying and selling inside of the active fund manager or whatever, what's happening is there is buying and selling, and ultimately the child pays that in tax at the end of the year when they get their tax statement from us or from the ETF provider, and ultimately that's the thing that does the damage, Mitch.
Yeah, exactly right. And so that's when, if we I want to just go back to my few little dot points there. That's what I'm going towards with why existing ready-made options for me aren't good enough. And that's why I thought a standalone product for kids was required, especially for people who are investing in the child's TFN and you're paying that tax, that higher tax rate. And so why I say like existing ready-made options, just like say your Vanguard diversified ETFs, your other service providers out there, like who invest in ETFs like we do, our existing Jupiter, Martian and Terra strategies, they're ready-made options. And whilst they are very good options for about 80% of the population or so, in this specific instance, because of that internal rebalancing, you've got two layers of rebalancing there. You've got the rebalancing within the ETFs themselves. So depending on if they use passive or active or how active those ETFs are, you've got rebalancing there. Then you've got rebalancing from the manager level, where they're rebalancing between the asset classes. So once a quarter, because most of these places, except for Rask Invest, most of these places do rebalance once a quarter. And so within, say, you look at VDHG, for example, they'll be rebalancing back to their strategic asset allocation of X% Australian equities, X% international equities, X% cash and bonds. And that rebalancing is also triggering tax events. And so you don't see that as an ETF holder or a holder of these types of accounts, but you are incurring that, and you'll see that's why you get a tax statement with any ETF, or especially a diversified ETF, which will break down the income components, be it from the actual dividends paid by the underlying companies or from the tax events, like the capital gains from the rebalancing. And so that's why I say, in my point of view, and when I was looking at investment options for my child for the next 20 plus years, we don't want to let tax implications, guide this investment 100%, but it's not how I do it. If I was doing this myself with just 2 ETFs or 3 ETFs, what I would be looking to do would be to rebalance with my contributions, avoiding sales, and only doing that rebalance with through transactions, through sales, when it's absolutely 100% necessary. Which, if I'm effectively managing this portfolio, that is few and far between.
Yeah. So whenever someone drops money into their portfolio, they're buying, not selling, and they're not crystallizing tax events.
Yeah. So, and that's exactly how it's going to work with, or is working with, Luna. It works like that as well with the other Rask portfolios, because it's all running on the same system. But essentially, in the background, let's just say with Luna, it's a 60-40 split between our US exposure with IVV and our Australian exposure. That's a static model. Your account is floating, okay? And so once, when you might be adding money once a month or adding money once a quarter or whatever, when those funds are added, dividends received, etc., the cash builds up. When that exceeds 2% or more in cash, we'll then rebalance the portfolio. What that actually means, though, is we'll look to see what of these 2 ETFs is actually underweight at the time compared to the static model. So this is why it's important that we've said this portfolio is for kids, because we're going to be, hopefully our investors are going to be adding what they can when they can. And that's going to be helping the rebalance, rather than us chopping 5% from this position to put it into this position over time.
There's 2 questions here which I'd like to get to, Jason's and Sensei's. So will Rask set it all up for them, like parents, trust, etc., or do they have to do it themselves with an accountant? Sorry for the questions. I'm going to show you something, Sensei. Here, I'll bring up my page again. So when you log in, you'll have your dashboard just like this. Sorry for all the moving. My mouse is the wrong way around. You will see a drop down here that says, this is switching from my account, say, to my sister's account, kid's account, family trust account. It doesn't really matter. When you create a portfolio with us, this is what it would look like for a new investor, just if someone hasn't done it. It kind of looks like, wait for it, loading. It will look like a standard application on our end, and you'll just select the portfolio. You'll see what type of account it is, and this is where someone can come in, whether they're an individual, joint, company, they want a kid's account, like whatever, it doesn't really matter. There's also trusts and these types of things in here. So parents that have a family trust, like I do, or people that are just investing in a name on behalf of a child, like this one, they can click this. They don't need a family trust or anything like that. They can just click this button, pop in the amount, say, for example, like this, and then go through the process of the standard application. Now, this is just an example, right? But who actually sets up a big family trust is an accountant, not us. That's just like the very basics. But what we're talking about is we know a lot of our community don't use a family trust. So that you don't need one of those to invest 4 kids on our platform. You never have. The difference is the actual strategy which you select is the thing that's changed a little bit, because this is what we're trying to target and it relates to Jason's question here about does Rask give a rebalance heads up? So one of the things that we like to do, Jason, is we don't tell you every time we rebalance, because as Mitch said before, if I can just turn this off, sorry, 1 second. As Mitch said before, every individual investor's account is floating. And I'll give you an example of that in practice. Actually, this illustrates it. If I go back to my dashboard, and you can see that my performance through time is 10.34% right here. Yeah. But if we come back and we go to this performance, you'll see that it's changed, like since Mitch took these numbers, right? And so the key thing is there that like every individual investor's is their own portfolio. And so it's going to change through time. So we wouldn't be able to say to each individual exact person, hey, your account's going to be rebalanced, because that's not really how we think about it all the time. what we tend to think about is, okay, this, IVV has rocketed. We need to figure out, are we going to rebalance now? And the investment committee sits down with us and goes over that. The actual reality of us having to rebalance, like across everyone's account, is very, very slim. What would more likely happen is that we would make an adjustment for like an ETF, or maybe we move from cash and we go, all right, guys, the stock market's fallen. We're going to use our cash pile and we're going to top up some of our US shares or our Australian shares. And in that process, there would be adjustments made on people's accounts. And that's probably one of the things how we kind of like course correct. If you're in retirement, you don't, maybe it's a different situation, but that's how we kind of course correct. And when someone adds money, we typically top up the positions that need to be topped up to keep it as close to possible as that original, what we call strategic asset allocation, but the original blend. There is one extra thing I'll say here, Jason, which is where we're very different. Recently, we told people that if we're going to make a change to portfolios, like say an ETF or a different mix or something, we will send everyone an email and we will say, hey, we're going to make this change in the future. It makes sense to do, like, if you're going to put more money in, to do it now, and we will hold that money and rebalance using that money that's not going to be taxed, rather than sell something in the existing portfolio. So this is something that we have talked about many times, including with some of our investors, to make that a reality. One final thing I'll say before I move on is when it comes to the not having a family trust thing, I want to make it very clear about this. Based on what I can determine from the math, you have to, in my opinion, you kind of have to start going beyond, I don't know, 25, 30 grand per child's account for it to start to make a real meaningful difference to think about a family trust. That's just, my math. I'm not your local accountant that can do it for you, but that's just based on my assessment of it, right? So for the vast majority of people, going down the family trust route is probably not something that they need to do necessarily. They can do the other strategy, which is where the legal owner is the parent and the child has their strategy set up for them, with the child being taxed. And because the investments aren't turning over, they're not getting taxed a lot along the way, you can typically manage that. Now, that's general in nature. I'm going to be very clear. One thing Mitch and I will talk to you about a lot through time is that, one, we don't know your circumstances. We'll always say that. But the second thing is that when you invest in something, and not just with us, but with anything, and it's for a kid, ideally what we want, all of us will say this, is we want something that can keep growing beyond the age of 18 and can keep compounding for decades to come. And that is why we chose the 2 ETFs, which we did, to go in this strategy, and why we kept it simple. Because let's imagine someone gets to 25 and they don't want all growth. The child inherits the portfolio and they're like, I like the sound of that Jupiter strategy. Now, all of a sudden, the child's got the portfolio and they're like, but I don't want to sell. I'll just tell Rask I'm going to put more money in, and they'll go and top up that other bond position, and they'll tinker with this, and then it will keep growing. And so you kind of get this approach where you can kind of palm it off to kids at the right age and then change strategy, and you can kind of keep gliding through time. That's our hope. So I hope that makes sense to everyone. It's a little bit difficult, Jason, just I know you said perfect explanation. It's a little bit difficult for us to do it for every single person individually with that top-up notification, because there's a whole bunch of laws that get in the way around this. But we are going to make sure that everyone in our community understands after-tax returns, because it's exactly what Mitch and I are thinking about. No one else tells you about this because they don't care. They really don't care, because all they care about is putting that before tax number on the account, because that's all they're legally obliged to do.
Yeah, they other service providers will tell you their job's to manage the model, and which is true. When we put our performance numbers up there, and when any fund manager puts their performance numbers out there, they cannot put after-tax performance figures out there, because they don't know. The tax situations of every single investor is completely different, but it's something that's front and center on our minds. So I just want to answer a couple of quick questions here. Justin, yes, you can switch, mate. Just email me. I know you've got my email address, but anyone else out there that doesn't, it's mitchell@rask.com.au. You'll be able to reach me, or jump on the website chat as well. Owen and I are often on there having a yarn to people, just like we were with Derek this morning and yesterday. So, Derek, your question here: what is the minimum and the optimal monthly discount? Dollar cost averaging contribution for the kids portfolio? It's actually the same for a standard Rask Invest portfolio. I'll just let you know how it exactly works. So at all times, it's our job to ensure that your account tracks the model that you're aligned to. Now, cash is a percentage of each of the models. Even in Luna, it's 1%, and that's to avoid us doing transactions to free up cash for you for fees. Now, when you add cash to your portfolio, your cash as a percentage increases, and that increases compared to the model. Now, when that pushes above 2%, we then make transactions for you. That's that cash bucket in your account is a combination of any cash that you've added, plus then distributions coming in from the ETFs. So if using our automated monthly regular investment service, that comes with a minimum of $100 a month. I know that is popular, but what is also incredibly popular amongst people, and I know our Rask community is quite relatively analytical, they like to really maximize the impact of that cash coming in and maximize the brokerage costs associated there. So what I know a lot of people are doing is waiting for the end of the quarter when all the dividends roll in. So say, for example, come the next period will be January. So come roughly at the end of January, people who are doing that strategy will add their contributions then. That will then be bundled up with all the distributions that have been paid in January, and that's when the purchases to rebalance the account will take place. That's the way to get the most effective use out of the brokerage for your account. Now, saying that, the most effective for someone is not always the most effective to someone else. I see a lot of people do that strategy, and that's great. And I'll start actually emailing and communicating with people to say, hey, if you are doing this strategy, here's the new the dividend dates when they're announced, and so this is when to time the contribution. There are other people who I see transfer cash in every single week, and that's because it works best for them personally. Because if the cash sits in their own account, they might spend it. So it's better off in their investment account, out of sight, out of mind. So it's 100% up to the individual and how they prefer to work. Some people just love the idea of set and forget and have the contribution pulled by us from their account, which happens on the 15th of every single month or the closest business day thereafter. And this is incredibly popular, people set up a recurring BPay payment. So a recurring BPay payment, you can set it for any day of the month, fortnight, quarter, etc. On your time frame. Also, the benefit of the recurring BPay payment is if for some reason you don't have cash in your account at that point in time, to my knowledge, there's no rejection fee. So if we go to pull money from your account as part of our regular contribution plan and you don't have the cash in your account, when we pull it or attempt to, your bank will sting you with I think it's about $15 these days. Yes, yeah. So because with the BPay payment, because you're pushing the funds, you avoid that.
I want to just maybe circle back to something that's a little bit unique around this as well. We talked to the community, Jason. I don't know if you remember this. We have a pretty big position in the VAS ETF. Particularly in our Jupiter strategy, which is our 90-10 strategy. And we're very happy with that. We're very comfortable to have such a large position in that. I'll actually just bring up the screen so you can get an example on this demo here. So when I go to the dashboard, you'll see, so this portfolio has got $22,000 in it. But if you look, there's pretty substantial percentage of that, wouldn't matter if there was $1 million in it, whatever, it'd be a very similar percentage, is in VAS. Now, we think that this is a moment for us as a investment business to illustrate how we might be a bit different in terms of how we can help people kind of, I guess, get the most out of their after-tax position. And that we've talked about, there probably will come a time where we diversify this. We gave an update about 4 months ago now about how we think that, for example, Australian banks over the next decade may start to struggle in their growth ambitions. And that may not necessarily lead to like a market fall or something, but it may result in suboptimal performance when it comes to growth. And so we are left with a decision here. Do we continue to have all of the exposure in this particular ETF? That's the top 300 shares, market capitalization weighted, meaning the biggest companies like the big banks get the biggest share of that ETF. Or do we maybe take a more tactical approach over a 5-year view or a 10-year view? The key thing for us is that we don't want to have to make a decision where we go, all right, we're going to take 10% out of VAS and put it into MVW, which is from Van Eck, and we're going to deflect some of the banks, or go into the X20 by Beta Shares, or whatever the case, or put some active funds in there, or some LICs, or some whatever. The key thing is we could tell you that that's coming and why we're doing it. We could tell you 2 weeks ahead of time because of the way that we invest and it's fully transparent. We don't need to kind of keep some secret sauce and say, hey, guys, we're not going to tell you what our stocks are. We're not going to tell you this or that. Just put the money in. We can tell you, hey, on this day, and we can tell the trading team, guys, we're going to do this. Expect our investors to park some money in here. Do it tax effectively. Do it cost effectively over time. And that's just where we can kind of signal to you. I use, for example, I'm a bit old school for anyone that wants to know. I tend to use the old BPay strategy. I just I've set them up in an ING and now NAB for bloody 15 years, and I still use them to move money around. Call me a little bit old school, but it does the job perfectly fine for me. That's what I do. Yeah. Now, Mitch, do we have any more to go through?
I think I've got a couple more dot points. And then I'll get off my high horse about kids investing.
Okay, so you got this?
Yeah, so we've been over why I think ready-made options just aren't good enough. This is a big one. There isn't really too many other services out there where it's specifically designed. A lot of in the world that we do, in the world that we operate, where it's specifically designed for kids, these types of portfolios. And I think it's purely a commercial decision by these other service providers. These accounts are not going to move the needle on your revenue. They are, they're small by nature, but they're growing. But it's an incredibly long-term investment. And so when you've got, you could be an ASX listed company and you've got shareholders that you have to report to every single quarter. You could be another service provider that's, owned by some very large multinational companies. These accounts aren't super profitable for a business, and you might even actually lose money on them. But this is the benefit, and I've said this to a lot of our investors. Rask Invest is a service that we genuinely believe will be here, and we'll be working on it alongside our investors for the next 5, 10, 15, 20 plus years. And so we're very happy to put something like this in place with that time frame in mind, and build this business slowly and gradually in a way that we can be very proud of. And I think putting this as our first new portfolio in place is definitely something that I'm quite proud of.
Yeah, definitely, Mitch. And it would be great to have kids being able to come along to our events with their parents and knowing that they've got money online. We've had that in the past. We've had actually the kids drag the parents or the grandparents along, which is the perfect combination. But that is basically why we exist. So it makes sense philosophically longer term for this to happen. But we're not the only option for people. to invest. And I think this is important to understand.
Yeah.
There are other options available beyond just diversified ETF portfolios. There are plenty of options, and there's some here on the page, for example. So a DSSP is another wonderful piece of industry jargon, but what it stands for is dividend share substitution plan. Dividend share substitution plan, and there are only a handful of these in the country.
I think there's two. Is there two?
There's AFIC and Argo, isn't that about it?
Yeah.
I don't know if any others off the top of my head. I say a handful.
I'd imagine there's Argo, AFIC, plus the AFIC suite of LICs.
There you go. So these are listed investment companies. We want to make you aware of these because they could complement what you're doing. We might even invest in some of these other things through times ourselves or as a business. But so this is where you can invest in a listed investment company. A listed investment company like Argo, AFIC are on the ASX. You use your brokerage account to do that. And basically the benefit is that instead of paying tax on the dividends, the tax is rolled into the long-term capital gains. And it's a pretty unique thing, and that's why it's pretty administratively heavy. That's why not many of them do it. It's a reasonable way to go about investing for kids. One of the key problems that our community finds is that it's a listed investment company and people aren't always happy with the performance of the actual thing that they're invested in. So they often feel like they're a little bit stuck in terms of they have to hold this thing and keep going. There's a franking credits issue there as well to keep in mind. You can just invest directly in shares and ETFs. We don't have any direct stocks in our portfolios as yet. We can do that if we want to do that. And that may be something that we offer in the future. But right now, we do not. But you could invest in, say, BHP shares or CBA shares. You get franking credits. And one of the benefits of shares versus ETFs is that an ETF gives you a tax statement at the end of the year and you just fill that in, or you do it with your accountant, or you take our tax statement and you just use the ATO portal. But shares have an added benefit in that they don't give you that tax information. But one thing they do is you don't pay tax on the capital until you sell. So that's a little bit different to ETFs where you may have to pay some tax, over time. But we've obviously tried to take care of that by picking ETFs that kind of suit kids investing. The third option here is an investment bond, and something that you'll hear about on the Rask podcast starting tomorrow morning, actually. On the Australian Finance podcast, we had Grant Hackett here in the studio. He was just sitting over there, and he was about 7 foot taller than me. And he's a lovely guy, and he heads up a business that sells investment bonds. And what are these? Investment bonds are very, very tactical financial planning tools, and you can use them as an individual as well. And it's just like investing in super, except your money's not locked up until age 65. There are fees involved, but you can, for example, set one up, what it is it's a tax structure, and then within that tax structure there are investments, just like a super fund. And then after 10 years, provided that you follow all of the rules, it's capital gains tax free. And that's because the bond itself pays your tax, not you as an individual. So they can be quite powerful for families and people with larger portfolios. I typically find that investment bonds are most popular for families where the two parents are on the top marginal tax rate and or expect to pay a lot more tax in the future. So that's something to consider. There are fees involved, but listen to the episode that's coming up soon. Grant makes a very compelling case, as a very good salesman, about investment.
As the CEO of an investment bond business should.
Should I buy this, Grant? Well, yes, you should. But that's a really good episode. And it's like, to be honest, it's reasonable. Like it's for some, the way I think about risk management in my life and my finances is I don't do everything. I don't do all of everything in one thing. I don't think that's the right way to invest money. I don't think it's the right way to eat. I don't think it's the right way to exercise. Like I don't just go to the gym. I do a little bit of running. I don't just eat this one thing. I do a lot of different things. And I think with your finances and your investment structures, it should be the same. So I would imagine for myself personally, I will probably do every single one of these things. Maybe the DSSP, as Jason's just corrected us, may not be on my menu in the next 10 years, but maybe it is. And that'll be okay too. But we want to bring these to you to say, these are like what we do isn't the only thing. And there was a question here or a comment made by Caroline earlier on about something about being able to invest super with Rask. SMSFs, we do them every single day. So bring it on. Whether it's an industry fund, though, we're not an Australian super yet, so we're not at that level, but maybe one day. But there may be options for that in the future and the ways we go about things. But the final thing here for kids is trusts, and by that we mean family trusts. So these are legal trusts that are set up. They typically cost around about $4,000, I would say, if you're going to be conservative, about $4,000 to set up. They're most common for families with businesses. That's what they're most commonly used for, but also high net worth families use them because they can stomach the $4,000. And there's also ongoing tax and a few other things to go around. Like just try creating a bank account for a family trust. It's about 10 times more difficult than just an individual. That's not for everyone. From my understanding, I believe that family trusts are for people that have more complex needs, complex families, very high incomes, like current incomes or expected high incomes. Another good reason to use them is if you run a business and you're worried about legal risk. I think like if you get sued or something and all your assets are taken, family trust can help in the court of law. It's my understanding. I wouldn't necessarily, again, rely on all of what I just said. I would also consider the other options that are available to you and speak with someone. So there's a good question here from John T. You guys always recommend seeing an accountant. What's the best way to find a reliable one? I would just shop around a bit, John T. We had Gemma in the studio, who you'll hear from on their podcast coming up, John T. And she said yesterday, it's quite interesting. She said this over dinner last night. She said, when you go to the mechanic, you don't really know what's going on. But a lot of people, when they go, they get a pretty bad experience and they go, oh, bloody, that mechanic, I tell you what, said he would have fixed it. That's it. I'm not going back to him. But when it comes to accounting and when it comes to finance, you know what people tend to do is they tend to say, oh, that bloody financial advisor, they're all crooks. I'm never seeing a financial advisor again. But the key thing is not all of us are the same. Not every accountant's the same. Not everyone is the same. You wouldn't go to the mechanic and be like, that bloody mechanic, that's it. I'm never seeing a mechanic again. Like you would just shop around. And so I'd say shop around. Find someone that has experience in with investors and just call your current accountant and be like, hey, I'm thinking of doing this. Is that something that you know much about? And if you'll get the sense if they're being honest or not. A lot of accountants don't have a great depth of experience with investing. We've partnered with Grayspace and they do a bit of this for our community and they're starting to do more of it. Pretty busy lads up there in Sydney, I must say.
Yeah, if you on the Rask website, just under the services tab, you'll see accounting. You click on that, you fill out a short little questionnaire, and that'll connect you with Grayspace. If you ever listen to the Australian Business podcast, you'll often hear the boys on there.
Yeah. I'm just going to be real with you at the moment. These guys are incredibly busy. Of all of our partners, they're probably the busiest right now, John T. So I just want to set expectations. They'll still have a call and have a chat, but they're very busy. I'll just pop the link in the chat just so you've got it. But accounting is one of those professions where there's experts within different genres and different whatever. So just shop around. If you don't have the answer that you want, keep going and speak to some friends. And I think that's good policy anyways, just to know who you feel comfortable with and work with them. One final thing I might say is you will get a copy if you're on our mailing list, which I imagine all of you are, seeing that we kept today's live a bit covert. If you go, you'll get a PDF, which is the Rask Owner's Manual. It doesn't talk about Luna, like the kids strategy that we're talking about today, but it does talk about the types of investors that we're looking for, how we plan to grow the business, why we invest the way we do, all that stuff. So keep an eye out for your email inbox. And if you have any questions, you can get in contact with us via the website or by just reaching out to Mitchell himself. There he is, right there. You can use these resources here that are available to you. We'll be updating this guide for investing for kids so we can explain how to do it with us, as well as there's some helpful docs as well. Jason, you said, I went through creating a trust recently with ClearDocs plus CommBank plus CommSec, and it wasn't too expensive. Ongoing maintenance, tax returns, etc., is the painful part. Yeah. You know what? There's a lot of good solutions out there, Jason, that are like what we would call, they used to call them e-solutions, thinking that was like electronic versions of things, or then it became the I version, like the iPhone and things like this, and then it became more intelligent. My experience dealing with some of the online solutions, I don't know anything about this, but my experience dealing with them is that a lot of people become a bit disgruntled with the kind of light versions, and they often resort to working with a finance professional in time because they realize that a lot of the kind of the online solutions aren't always what they want. So just keep in the back of your mind that, I might need to get advice in the future. Will this service provide that advice? And it probably does. I don't know. But I prefer to go to a human for these types of things, just in my personal take. It's just good to be able to call someone and complain about something, to be honest. Yeah. So, Mitch, have we covered off everything that we need to for today's show?
I think we've done a pretty good job. Yeah.
If we do say so ourselves. We're online basically 24/7. So you can jump on the Rask website. It's bottom right corner if you have any questions that are follow-up. Like Mitch said, we're kind of taking it slow with the Lunar portfolio to begin with. But if you want to jump in and have a chat with us, book a call, do those types of things. Caroline said,
sorry, going on.
Caroline said, no, not sure if this was mentioned before. Do I need a Rask membership to invest? No, you do not. No. So we've got two different services, Caroline, and one of them is DIY. That's the Rask Core membership where you get all the portfolios and the ongoing updates. You don't need to invest with us. And then there's the other one where it's called Rask Invest, and that's the one where we do it for you. So you can just copy the strategy in your own account. There's no issue with that whatsoever. And you're going to see more of that in the new year. So
yeah, just keep in mind with Rask Invest and the Rask website, rask.com.au, they're actually two separate logins. The reason for that is Rask Invest is built on a specific platform, and it also has quite high security levels as well, being an actual investment platform. Like, for example, two-factor authentication is a requirement on Rask Invest. We want to do our absolute best to avoid the front page of the Fin Review for the wrong reasons. So we're very security conscious there. So when you're creating a Rask Invest login, it's a separate one. So just keep that in mind.
And same with when you log in. We're working on technical things behind the background of how we could potentially bring them together, but it's very difficult given the enhanced security of this versus our public version of our website, which doesn't take any financial information or anything into account. But if you go up the top on our website and you go to this investing under topics, it kind of breaks it down about how it works and how our business is trying to evolve through time, Caroline. So if you go down to here, you see an example of this. You see you can invest with us where we do it for you, not you, just anyone in general. Or we do the research, then you do it yourself, like in Perla or CommSec or whatever people use. That's very common. And then there's the final one, which is we won't even research for you. We'll just teach you how to research. And there's going to be more of that. That's on our education site. So just to be very clear, when you invest with us, it's a different level of security, obviously. So that's on a different portal to the other two. And we're going to make that more apparent in the future. So hopefully that makes sense. Thank you, Mark. Thank you, everyone that joined us today. A nice, relaxing session coming into Christmas. If we don't see you next week, we'll be back. We've got a Christmas special on the Rask Invest live show and a lot of great discussions and interviews coming up. There's the Grant Hackett episode, which I referred to. There's some seriously good stuff coming up over the next few weeks.
I get one of the perks of working here is getting access to the back end of our YouTube channel. And so I can see what's coming up. And so I've skipped ahead and listened to a few already. And
what would you say is your best interview of the last month or best podcast of the last month?
I very much, because I just love this guy's writing. And I'm now reading the book. Absolutely love the Joe Aston interview that you've got coming up. I don't know when it's coming out, but I really enjoyed the Joe Aston one. It was great to snag Joe, and just talking about Qantas and corporate governance, etc. It's a fun topic.
Yeah, so Joe's episode's coming out soon. It's going to come out on the Investors Podcast first in the next 3 weeks. I'll tell you my favorite. I don't normally play favorites, but given it's just a few of us here, my favorite podcast that hasn't yet released, but it'll be released early in January, is with Chow Ma. We recorded with her yesterday.
Yeah.
And
from Munro Partners, yeah.
I think she's probably. I came out and I don't know if you heard this. You might have been on a call, but I said to the team, I reckon she's probably in the top 5 or top 10 of all time presenters on the Rask Network, and we've done over 2,000 podcasts. So keep in mind, it's only relatively short. It's about 55 minutes, but that was exceptional, and she's a great investor. So.
I'll tell you what, I've not listened to this one either. Sorry, guy, we're getting ahead of ourselves, but we're starting to interview a lot more CEOs as well, and we had the CEO of Aussie Broadband come in and join Owen. So it's been we've got a few more CEOs coming up in the new year from some pretty big ASX 200 companies. So if there's anyone that you want to see, just reach out and let us know, and we'll try and snag them.
Yeah. It's if you're investing in a company and you haven't heard from the CEO, if it's a small, mid cap, large cap, let us know, because we're starting to do a lot more of this. So, John T, have you considered an Australian trading podcast for individuals seeking gains more in the short term? So we're strictly long term, John T, but there are some good podcasts out there that focus more on that. And there's one in particular that focuses on like options trading and stuff like that. If you're interested in a really technical thing, that's available on the This Is Money network. It's kind of like, I think they call it This Is Investing, but it's mostly, in my opinion, it's more like shorter term stuff. That's a good one. But we've had some great investors on that talk about this stuff. I'm trying to think of his name off the top of my head. Got his face stuck in. I'm going to come back to you, John T. There was a great discussion that we had about more systematic trading and momentum trading not too long ago. Oh, it was about a year ago.
I was going to say you did have one 2 months ago.
Not Scott. No, that's Scott Bennett. No, there's it's Nick Raj. That's who it is. So I'll bring this up for people, and this will be the last thing we say before we shut up and get off.
Just waffling now between ourselves.
Yeah. So this Nick Raj Rask podcast, this discussion with Nick was one of the community's favorites, and I don't know why that's come up like that. It's normally a full video. Where are you? Nick Raj Rask. Here we go, this one. I'll put the link in the show notes and the video. So this here with Nick is like really, really great. I'm not obviously he's not even a technical analyst really. He's a systematic trader, but this was really cool. A really good discussion up there in Noosa where he's from. So John T, have a look at that, mate, and let me know what you think. I had a bit more hair then. There he is. And he's wearing a t-shirt that says "Be kind." He was a very kind person. So that's good news. All right. Thanks everyone for joining us. Don't forget about Luna's out now. Mitch, well done, mate. I know you worked really hard to get here, so kudos.
Reach out to me if you want to have a chat to anyone. Or I do a lot of video calls. They're a lot of fun. So Mitchell at rask.com.au. Also, obviously, now that we've got a kids portfolio, I want to hear lots and lots of tips on how to engage your teenagers and your kids, etc. So when they do turn 18, they're ready to pick it up and run with it and actually do the right thing rather than just blow it on a car.
Yeah, well, hopefully I probably wouldn't have listened to that advice. But hey, Caroline's just given us one more thing. She's kind of she's baited the hook and put it out there. Any Rask merch yet? Hey, Caroline, good news for you. We get the shipment on Thursday next week. So over Christmas, we're going to do a very limited opening for people who want Rask merch. We've got t-shirts of various kinds, and we've got 2 different styles of caps. Sun Smart policy applies here at Rask HQ. So If you want some, Caroline, stay tuned for the emails because I'm excited to get it. So you'll see it come out soon. Mitch, everyone, thank you.
Let's get out of here. Thanks, everyone.